Hey guys, welcome to this module. Now in this one, I'm going to run you over some of the major risks and traps that beginner investors often get caught out by. And these can cost you a lot of time and money if you were to go and try and learn these alone. Some of these come from the mistakes that I made and the lessons that I learned during the years that it took me to go from a beginner investor to growing my portfolio well into the six figures. And that's my goal for you members as well. And once you learn these risks and traps and just how to avoid them, I'm confident that it's going to significantly cut down the time that it'll take you to be successful in this market. So let's jump into it. Now, the first main risk is emotional investing. Now, emotional investing may be the number one cause for people never becoming successful at investing and making money over a long period of time. And this is even more true in the crypto markets because it's such a volatile asset class. And it can be really hard for inexperienced investors to watch their accounts fluctuate in such short periods of time. Now, the cycle that I most commonly see is that investors enter the market as prices are moving up. They start to get overly excited because their portfolio is growing in value and they think that they're going to miss out on extra returns if they don't buy in more. So they dump some more money in hopes that it'll continue to go up. But when the market inevitably has a decline, they sit there and they watch their portfolio value decrease. They start to panic that they're going to lose all their money and then they sell. Without realizing it, all these investors are doing is just buying high and selling low. Now that's a complete opposite of what a successful investor does. Now, as we dive deeper into the modules, we'll show you strategies that will help you make consistent decisions that aren't driven by emotions. Now, the second risk is that crypto is still a highly speculative asset class. With all the excitement that surrounds the crypto market, it's easy to forget just how early we still are. This asset class has only been around since 2009, and until countries have decided just how they're going to regulate it, there's still going to be some uncertainty that surrounds it. This just means that in the meantime, it's much more risky investment than something like stocks that's been around for over 100 years. So you just need to keep that in mind when you're investing. With all the excitement that surrounds the crypto market, sometimes it can be easy to forget just how early we still are. Crypto only started in 2009. Now, the third main risk is that people have to take complete control and responsibility for the security and the storage of their coins or tokens. Now, unlike traditional finance, where the banks are middlemen to our transactions, crypto's decentralized nature means that one of its biggest positives also has its downside because it's almost impossible to recover your lost crypto. Whether that's losing your private keys to your account or sending your crypto to the wrong address, it just means that we need to be on the top of our game when it comes to security and management of our crypto. Now, while this all may sound scary right now, don't worry. We're going to show you the exact steps that you need to take to make sure that your crypto is 100% safe. And now, risk number 4 is that projects that look really good can still go to zero. Now, this goes hand in hand with the market being highly speculative. The majority of projects still haven't fully matured and they're still upgrading and ironing out the kinks, and this all just takes time. Sometimes even really solid projects can find it hard to anticipate certain situations, and no matter how good they look, they can still go to zero. Now, this just means that it's even more important for you to know exactly what to look for when you're thinking about buying into a project. What you can often find is that a project will look really good from the outside. It'll have a lot of social media attention, which will suck investors in, pumping the price up. But if you dive in deeper, there's just nothing in the back end that's providing real value to keep that price up. And this just increases your risk of losing money. Now, let's move on to some traps that you should avoid. Now, the first main trap to avoid is shiny ball syndrome. Now, shiny ball syndrome is a name that's given when investors that are usually inexperienced will bounce in and out of coins or tokens every time they see a shiny new ball of potential. A good example of this is when people were chasing the meme coins that gained a lot of social media attention, and people were just bouncing in and out of all these different meme coins, hoping that they could catch the train as it was going up. But what happens instead is they just keep chasing these shiny balls that they think are going to make them rich overnight. But what happens in the end is they make no money. They just get caught up in the noise. And similar to shiny ball syndrome is going all in on one project. Now, this is with the exception of Bitcoin and Ethereum. Now, it's easy when you're first starting out to get sucked into the hype that some of these projects have when they haven't yet proven themselves. Most have these die-hard communities that really make you think that it's either one or the other. And it can be easy to get what I like to call married to a coin, just go all in on it. Now, I made this mistake when I was first starting out, and it took me quite a while to realize that these communities are just made up of fellow speculators like you and I that have no more of an idea, and it's wise not to get your advice from them. Now, the third main trap is using leverage to get rich quicker. Now, leverage is a double-edged sword. On one side, it can multiply your returns, and on the other, you can lose every single dollar in your account. There are a few different ways that people can use leverage in the crypto markets, but one of the more common ways that we see is where people just leverage trade a coin or a token on a crypto exchange if they think it's going to go up or down. We've seen a huge rise in popularity for trading on social media where people portray this lifestyle of trade and get rich quick, which just isn't the case. The second way that's becoming more common is taking loans out against your crypto. Now, this is where people will put up a certain amount of their crypto as collateral, which will get locked away, and then they'll receive a percentage of that in way of a loan, which they'll often use to go and buy more crypto. Not realizing that if the price of the coin that they used as collateral drops below a certain point, they can lose all that collateral. And we know by now just how volatile the crypto market is, so this is risky business. As a beginner investor in crypto, it's wise to steer clear of all forms of leverage. Because when you buy with leverage, you potentially risk losing everything that you've invested. But when you buy without leverage, you have zero risk of losing your crypto because of the market fluctuations. And then usually if people are using leverage, they're also trying to day trade and time the market. This is when people will enter the market and think that they will be able to accurately predict when the market has bottomed out at a low price so they can buy it, and then also accurately predict when price reaches its peak so that they can sell it for a profit, and then they assume that they're just going to repeat this till they're rich. Now, it sounds good in theory, but usually what ends up happening is the complete opposite. Because trying to time the market as a beginner generally leads to emotional investing, like we spoke about earlier. You constantly worry if prices have fallen low enough for you to be comfortable to start buying, or if they've soared high enough for you to sell. You'll always be second guessing yourself. You should know by now that if you want to have long-term success in the crypto market, you need to completely avoid emotional investing altogether. In reality, nobody knows on any given day which way the market's going to go. And I'll show you simple strategies that help remove the need for even attempting to time the market in the upcoming modules. Now, I don't want that to scare you off, guys, but I think it's just super important that you understand what some of these risks and traps are when you're first starting out. But with high risk also comes high reward. And I'm here to show you how to navigate this market to avoid these risks and traps and make it as easy as possible for you to succeed. Well, that just about wraps up this one. I hope you enjoyed it. And like always, if you have any questions at all, feel free to put them below this video and we'll get them answered as soon as possible. All right, guys, I'll see you in the next one.